Welcome to the InterMarket Analysis video update. This is a weekly video that I do to look at not only other indexes within the stock market compared to the S&P 500, but I also look at other markets just to see how things interact with each other. Stock market does not operate in a vacuum, and so I like to look at other areas, and sometimes that gives us some insight as to the stock market in general and the S&P 500 in particular. This is being prepared for Tuesday, January 17th. The stock market will be closed on Monday, January 16th, in observance of Martin Luther King Jr. Day. So the first thing that I like to go through and look at is the valuation of the S&P 500. And we've been hearing a lot more about that lately. This just gives us an idea. Looking backwards, this is the trailing 12 months, where we look back at the earnings reports that companies have already released, and they're part of the record that we can go back and look at. Now, this is a little bit different because the stock market likes to look forward, and it looks at forward PE ratios. Well, this chart looks at backwards PE ratios, or the trailing 12 months. This black line here is the S&P 500. When we're above this red line, that generally means the stock market is expensive because that registers a PE ratio of 20. You can also see this red line has also been declining a bit because the earnings have been coming down as the economy starts to have some problems. If we get down to a PE ratio of 15, which is the blue line, the market is considered to be fairly valued at that point. And if we drop all the way down to a PE ratio of 10, which is the green line or green dashed line here, the market is considered to be inexpensive or cheap at that point. Well, looking at this chart of the S&P 500 compared to the valuation levels, we spent most of the time being overvalued. And this is something that can go on for a long period of time. But in 2022 and now beginning into 2023, we've been really seeing the market coming down, and we're getting back down to the level where on a historical basis, the market is still considered expensive, but it's down from the really high levels that we had been seeing. On the bottom is just the difference between the current value of the S&P and this red dashed line. And even though it's been coming down, we're still above this blue line, which is a PE ratio of 20. Now, some folks think that this isn't really a good way to measure things because these are static numbers, 10, 15, and 20. Well, you can also look at this more on a relative basis where we compare it with the rest of the market. And as this is going up, generally the valuations will become a lot greater or become overvalued. And then at some point, the market comes down and stocks begin to be more fairly priced. Also, I have a chart here just going back to 1980, showing you the valuation levels and then what the S&P 500 did at that time with some different major events that have occurred. And way over here on the right is where we're currently at. And this can go on for a long time. If something is overvalued, it can stay that way for a number of years. If you use fundamental analysis or value investing to get into companies, you probably use a method very similar to this. When we drop down to the 10 area, that's considered inexpensive. You don't really care what the market is doing overall necessarily. And so you might buy. When a stock starts to become expensive, that's when you look to sell. Another area that we look at is growth versus value. And that's been a big tug of war in 2022. And so far, value has been winning out, and it continues to win. Growth are the big tech companies and stocks that really go up in a good, healthy environment because they're continuing to grow. Where value or more of the established companies, they've stood more the test of time. They may have products and services that are not necessarily as flashy, but yet they still maintain a lot of value within their company. The first thing that I look at is called the peer growth index. So we just look at all the different growth areas and put them into an index. And with the blue line below the red line, we see that it continues to be in an overall downtrend. So growth has been going down. And it started this back in early 2022, and it still is in an overall downtrend. Then we look at value, where it had been having some problems before, but lately it's really been going in an uptrend. So the value part of the market is really outperforming the growth part of the market. And then I have some ratios. Here's just growth versus value, showing how growth has underperformed and value has outperformed. And then another way of looking at this is some other indexes by taking a ratio of the two, showing that growth has really been underperforming and then is a downtrend, where value has been outperforming and is in an uptrend. Then we look at some ETFs and we kind of see pretty much the same thing, a downtrend for growth and an uptrend for value. And then this last chart just looks at a couple of different indexes. This is the growth index against the value index, and it shows how we had a bear cross back in early 2022, and we continue to be in an overall downtrend. Another area is to look at other markets. These are the biggest software companies in the US, and because the blue line is below the red line, we continue to be in an overall downtrend. Then we look at the CRB index on the top, which is commodities, and that continues to be kind of in an uptrend, but it's starting to go into more of a downtrend, and I'll show you a chart of that. Down below, we look at some inflation stocks. So when this is really going up, that means inflation is more of an issue, and we compare that on a ratio basis with deflationary stocks. Well, we can see where we've been in more of a deflationary mode for really going back from 2011 to 2016, and then we've been bumping around, and we're still in an overall deflationary environment, but we're starting to see things pick back up. We're seeing commodities really start to perform better, those things that will typically cause inflation. We're not seeing that in the reports that we're getting, and I'll address those in this video and in other videos, but we are seeing this coming back up where we had been in more of a deflationary environment. We could be coming back into more of an inflationary environment according to this chart. Another thing to look at for inflation is a thing called the Baltic Dry Index. How much does it cost to ship goods from one place to another? When this is going up, that means that the shipping costs are going up. When this is going down, that means the shipping costs are going down. And kind of in a contrary manner to what we just saw, this has been in an overall downtrend. Another thing is the CRB index, which is the energy contracts, agricultural contracts, precious metals, and industrial metals. You take them all together, and they were in a really strong uptrend. Well, late into 2022, we saw a bearish cross, and so we are starting to see more of a downtrend. Looking at corn, and I don't really do any studies on these charts. We just look at these overall prices where it had really spiked up, had come back down, and now it's starting to rebound a bit. Aluminum, again, another thing that can really feed into inflationary pressures. It really spiked up, but has since been coming down and is in an overall downtrend. Heating oil, which here we are in the middle of winter, it really spiked up, but has since been coming down. So that's providing a little bit of relief for folks. Gas, which really spiked up, has also been coming down, but lately has been starting to go back up. Natural gas, which also spiked up and is still continuing to go down. Oil, which also spiked up and has been coming down, and we're just under the $80 a barrel level now. We also look at diesel prices because that's how things are shipped, not only by truck, but by train. And these prices have really climbed, but they're well off of the high prices that they were at earlier. Wheat, which also spiked up and has then been coming down. As these go up, this feeds more into the inflationary fears. Well, with it coming back down, it's still pretty high, but at least it's not as high as it was. And so this is helping to get inflation more under control. Fertilizer, something that farmers need to grow crops, well, it really spiked up and has been coming down, but it is still at a pretty high level. And this is why we're seeing this follow through into the prices of things when we go to the store to buy them. Lumber, which had been in a really strong uptrend during the lockdowns in 2022, has been in a really strong decline, but now it's starting to bounce back up slightly. The dollar, which was really strong in 2022, has now started in a downtrend, and we've recently seen a death cross. And then we compare this to the euro, where the dollar had been really strong against the euro. Well, now we're just seeing the reverse of that, where the euro is starting to rebound and the dollar is starting to decline. We also compare this to the Japanese yen, which the dollar had been doing well against the Japanese yen, but now the yen is bouncing back as the euro is bouncing back and the dollar starts to decline even more. Here's the British pound. where it had been in an overall downtrend when compared to the US dollar, but now it's just about getting ready to cross back over for a golden cross. Copper, which is a measurement of the economy, where when this is going up, that tends to mean that the economy is going to get better. When it's going down, that means there's economic weakness. Even though there's a lot of evidence out there to suggest that we're going to hit some kind of recession if we haven't already been in one, this is kind of a surprise to see this really going up right now. So we're watching this to see, is this just a fluke that will be a short-term blip and then start to come down, or are we going to actually see a change in trend? Then we also have a gold to copper ratio, actually copper to gold ratio. This just means when this is going up, that copper has been outperforming gold. And then this is a longer term look at that same basic chart. And then we compare it with the 2-year yield. That's the green line here, where interest rates have really been going up. And there's a pretty wide spread between the gold to copper ratio and the 2-year yield, where typically these tend to go in the same basic direction. And even though they're on different scales, they tend to not get all that far apart. Well, they're kind of going in opposite directions right now, which is producing a lot of the economic uncertainty that we're now seeing. Gold is just getting ready to have a golden cross. It's been in an overall uptrend as the dollar has been declining and has been performing much better. Silver had a recent golden cross and is also now in an uptrend. Looking at some index ratios, when we compare the CRB index, the inflationary areas, with the S&P 500, the CRB index was really outperforming the S&P 500, but now is starting to show some weakness. And we just saw a recent death cross. And so the CRB is starting to underperform the S&P 500. And then this just looks at the S&P 500, how it was really outperforming, then was underperforming. Now it looks like it could be going back into outperforming again. The NASDAQ 100, which is a lot of growth stocks, they've really been underperforming the S&P 500. This is really a great index to be in when we're going up, but it can bring a lot of pain when we're going down. Looking at the mega cap growth, these are the really, really big companies, Apple, Google, Microsoft, the giants. They continue to be in an overall downtrend as well. And then the S&P 100, which are the 100 biggest stocks compared to the rest of the S&P, even though we're seeing some improvement here, they're still in an overall downtrend. Small caps have been starting to outperform and are in a bit of an uptrend right now. And that could be a positive sign. In a good, healthy environment, we want to see small caps really do well because they're considered to be riskier and folks are willing to get into those and take on more risk, because maybe their other investments are doing okay and they're considered boring, so they want to have some kind of adventure. Well, lately it's been doing a good job of outperforming the S&P. Low volatility stocks, those stocks that tend to hold up better when the market runs into trouble, just had a recent golden cross, but we've been chopping sideways overall, but they are still holding up nonetheless. And then we compare the low volatility stocks with the S&P, and it shows that folks that were in the low volatility stocks have really outperformed the rest of the stocks in the S&P 500. The Dow Jones Composite Average, this is starting to turn a little more positive. We've seen a recent golden cross. This takes the Dow, the transports, and the utilities and puts them together into one average, and it is starting to go into an uptrend. And the Dow has had the best looking chart if you go back to last fall, and I have another chart to show you of that. This is Dow theory, where we just look at the Dow. I don't put any other additional studies on here. I just look for divergences and convergences, where I'm not really seeing any between the Dow and the transports. Where I'm different is I also include utilities in here, and they've been performing fairly well, but we've seen some recent weakness. The FANG stocks, this is Facebook, which now is Meta, Amazon, Apple, Netflix, Google, and there's even other stocks included now. Taken as a whole, they're still in an overall downtrend. And ARK, which has really been in a lot of trouble, had a pretty good week this last week, but it's still in an overall downtrend. Looking at bonds against stocks, bonds look like they might be starting to show some improvement, although they're still in a downtrend, but we haven't seen that golden cross yet. And then world bonds, after really falling, have then been staging a bit of a comeback based on price. And this could help the overall market. As bonds continue to go back up, interest rates go down, and the stock market usually likes that, and that could give some support to stocks. The stock to bond ratio just shows that even though we're seeing some recent weakness on this monthly chart, stocks have really outperformed bonds for the last number of years. Then this is bonds against stocks, showing how bonds have really been underperforming. And then the stock to bond correlation, currently they're having a tendency to go in the same direction. When we're above this neutral area and it headed closer to 1, that means that they almost have a 1-to-1 relationship. If they drop below this neutral area and get down to -1, that means they're going in opposite directions of each other. So if we're going to see continued improvement in the stock market, we also would like to see bonds continue to go up. Here's the 10-year Treasury yield, after really spiking up, has been coming down, but rates are still pretty high overall. The 10 years at 3.511%. Corporate bonds showing some improvement here, but still in a downtrend, but we could be seeing a golden cross in the near future. Here's the 10-year yield after really spiking up. It has also been starting to come down as well at 3.511. 30-year down at 3.61%. So rates are a lot higher, and they had been going up, but they have been recently starting to come down. This is the S&P 500 to the 10-year yield, which shows that stocks have really been underperforming the rise in interest rates, but it is showing some improvement. This red line is the 200-day moving average, and the blue line is the 50-period moving average. Junk bonds, which folks tend to get into sometimes because they're considered more risky, but yet you can get a higher return from them. They tend to follow closer to the stock market, and after being in a significant downtrend, does look like they're starting to recover and could see a golden cross pretty soon. When we compare junk bonds to regular bonds, government bonds, junk bonds, even though both really suffered in 2022, junk bonds really outperformed government bonds. And then this is a daily chart showing how the yields have been changing. They've been flipping up and over each other as we go inverted at certain parts of the yield curve. But we've been seeing a general decline overall in interest rates lately, even though the last few days we saw interest rates going up. This is a weekly chart showing an international look where we have the UK, the US, and Germany. That's on the top. And rates have been going up and then are starting to come back down slowly. Down here on the bottom is Japan, and they just recently raised the rate that they would allow their bonds to go to because they're starting to see more inflation. But Japan is more of its own story, where the story that's more similar to what's happening in the US would be the UK as well as Germany. Looking at some different sectors, one thing that we like to watch, and this is one of our possible positive scenarios, is when the S&P outperforms utilities and starts to go up, a lot of times that will mark a low in the S&P 500. Well, we've been bouncing around. We're seeing a little bit of improvement right now, but we want to see this continue to go up with some other things that we're seeing that are changing the stock market and the S&P 500 to looking more positive. But we want to see more follow through with this ratio. Another useful feature of this chart is when we go up and spike up and start to come down, that can often mark a top in the S&P 500 as well. Looking at staples, the things that you have to have no matter what's going on in the economy, they have had a recent golden cross and are in an overall uptrend, even though they've been chopping more or less sideways. So they've been going down less than the discretionary sector, which just has been getting hammered since the early part of 2022. Then we look at energy against the S&P, where energy has been really outperforming, and it's continuing to be in a pretty strong uptrend. And the tech sector, which folks like to get into when it's going up, because these are the big stocks that give you the big returns, well, it still is in an overall downtrend, even though it's showing some improvements. The semiconductors, which are a big part of tech, it's still in a downtrend, but showing some improvement. And if it keeps going up, we could see a golden cross. The tech sector against the S&P shows how the techs have really been underperforming the rest of the S&P. Some other areas to look at are growth. which has really suffered, and bonds, which have really suffered. And so they've been chopping sideways overall. Growth is really underperforming, and we're getting ready to see a death cross here. Then we look at the 10-year yield against the tech sector, which just shows how interest rates have been going up when compared to how tech stocks have been doing. And then there's an inverse here showing how tech has really been underperforming the rise in interest rates. Discretionary, the things that make life fun and interesting, have been really underperforming staples, the things that you have to have, but we're seeing some improvement recently. And then in inverse of this same chart shows how staples have really outperformed discretionary. And then energy to the tech sector, energy has really outperformed as it's done well, where technology has really suffered over the last year. And then we look at gold against the S&P 500. Gold is starting to come to life. We're seeing a recent golden cross, and it's showing here that it's outperforming the S&P 500. And then gold had been really underperforming the dollar. Well, we're seeing that start to reverse now. High leverage loans, the risky loans out there. If the economy is really running into trouble, we would expect this to really decline because they're very leveraged loans, but no, they're in an overall uptrend. Then this is an intermarket analysis chart, just going back to the beginning of 2022, because not much of 2023 has happened yet, so it really wouldn't give us much of a thing to look at here. But going back to the beginning of 2022, oil has performed the best, followed by the dollar, but it's starting to see some weakness. Gold was negative for much of 2022, but is now starting to turn positive. Stocks have been negative and bonds have been negative. Then looking at some indexes, this is where we take the American Stock Exchange, the NASDAQ, and the NYSE, and we take a 5-period moving average of their highs minus their lows. It's looking like we're seeing some improvement here. Sometimes we can use this as a possible positive setup. When we see a real extreme reading to the downside, a lot of times that will coincide or be close to a low in the S&P 500. Well, we've seen a bunch of those extreme negative readings, but it really hasn't produced a lot of support for the S&P 500. As we continue to go up, this line will also go up. But if we start to come back down, then we will see weakness in this chart again as well. Small caps starting to get close to a golden cross here. They have been performing quite well lately. Mid caps also had a recent golden cross and are now in an overall uptrend. The Dow, which has also been in an uptrend and is coming right up to this resistance level, but it's been performing well lately. And this is the Elder Impulse system looking at the diamonds, which is the ETF attached to the Dow. It is an overall uptrend. The NASDAQ, which is still underperforming and still in a downtrend, even though it's showing some improvement. And then the NASDAQ 100, also downtrend, but showing some improvement. Here's the Elder Impulse system, and it's showing where the NASDAQ 100, represented here by the QQQs, it has been in an overall uptrend, but it still has a lot of damage that it needs to repair. The NYSE composite, which is another broad measurement of the stock market, had been in an overall downtrend, but is starting to show more improvement. The Wilshire, also another broad measurement, getting above both of the moving averages, but still in an overall downtrend. And then all stocks, not only in the US, but internationally, showing some improvement. We're seeing a lot of improvements in the emerging markets, and I have a chart to show you where if we continue to go up here, we may see a golden cross with this chart. Here's the emerging markets where they've been in a pretty solid downtrend, but they're really starting to recover, and they may see a golden cross in the near future if they continue to go up. This is an international look where we had been down pretty much across the board. Well, with this indicator, we're starting to turn back up in China. The emerging markets still looking a little bit weak in Europe, turning up a bit in Japan, and starting to turn up in the US. Bitcoin, which has been sitting around the 16,000 level, has now shot up. The last time I checked, it actually broke into the 20,000 level, but still a lot of damage was done on the way down, and it will have to take a lot of recovery for this to show some improvement. So I just wanted to bring that chart up here. Some correlations that we keep an eye on. The S&P 500 to the dollar as the S&P has been going up, the dollar's been going down. And if that continues, that could give some more support to stocks. The stock market tends to like a weaker dollar. And when this is declining, that means they're going in opposite directions of each other. Also, S&P to the oil, they've had a slight tendency to go in the same direction, but they spent a lot of time in the neutral area. And then the S&P to the 10-year yield, again, as interest rates are going down, stocks have been going up as of late. If that continues, we would still see this inverse relationship with each other. And here's the tech sector, which has really been suffering against the 10-year yield, shows that they're having a tendency to also go in opposite directions. The S&P to the 2-year yield also going in opposite directions right now. So what are the things that are positive? There's a few changes here. The value indexes and ETFs, they've been outperforming the growth indexes and ETFs. Gold, we're just seeing a golden cross there. Silver with a recent golden cross. Energy has still been doing well, even though it gets into periods of weakness. Interest rates are really mixed overall. Some are still headed up, some are going down. High leverage loans are still doing quite well. Staples, the things that you have to have, is in an uptrend. The Dow, the small caps and the mid caps, and then the low volatility stocks still continue to perform well, and the Dow Jones Composite Average. So this list was very short for most of 2022. It's starting to get a little bit longer. Here's our negative side, which is getting a little bit shorter. We still have the software that's negative, the CRB index, the dollar, world indexes are still negative but showing improvement. Copper, as we talked about, with it spiking up, it's still in a downtrend, but is showing improvements. Junk bonds are holding up okay, but an improvement, but still in a downtrend. The FANG index, NASDAQ 100, the mega cap stocks, the really big ones. The NYSE composite, all stocks, but we could be seeing a golden cross coming up pretty soon. ARK, which has really had a lot of trouble. Bitcoin, a lot of trouble. The Wilshire Index, as well as the Treasury and corporate bond prices, have been showing some improvement. The tech sector and semiconductors are still in overall downtrends, even though they've had some recent strength. So thank you very much. I hope you found this helpful. There's other videos that I post. Every day I post a video called the Daily Brief. Then I also do a weekly video, which takes a bigger look at the market. And then I post another video on the market where I show all of the charts that I don't talk about in the videos, just to give you updates on those. So have a great week, and I will talk to you in the next video.